Let's see bonds and their valuation. Bond is a debt security which is a long-term debt agreement on interest rate and maturity between issuer, which is borrower, and buyers. Buyers are lenders, investors. There are four key features of a bond. A bond should have par value, which is face amount that will be paid at maturity. Coupon interest rate is stated interest rate, well, promised interest rate by the issuer. That is coupon interest rate. It is fixed. And if we multiply par value and coupon rate, and then we can obtain coupon payment for every period. Maturity is number of years until bond must be paid in cash. Yes, it declines as time passes. Issue date should be printed. Let's look at some kinds of bond. Treasury bond, many times we say T-bond. It is issued by the Department of Treasury, by the federal government, right? Corporate bond is issued by private companies. Municipal bond is issued by cities and counties. And, well, income from municipal bond is, well, tax exempt. Foreign bond, it is issued by foreign companies and governments. Coupon bond is the bond that make periodic payments to bondholders for the life of the bond, and then pay the face value of the bond when bond matures. Let's look at a little bit more about coupon bond. This picture shows well, a coupon bond a long time ago. Well, bond issuers don't issue this kind of shape of bond anymore. But let's look at this typical coupon bond. Again, it's a long time ago. Maybe our my grandparents used this kind of bond. Here, the face value is appeared here, $20, right? And this is called par value. Face value. That's par value. Appeared like that. It says 3%, right? 3%. This is coupon rate, right? 3% coupon rate. Well, this is called coupon bond because it has many coupons, right? Coupons are attached here. Well, if this is a semi-annual coupon, then every 6 months, this bondholder will cut this up and then redeem every 6 months or every year, like that. Coupon payment, and then the issuer we should pay, such as face value. That's $20 in this case, times 3%, which is 0.03. It gives us $0.6. That's 60 cents, right? So this is coupon payment. This is coupon payment. So this is a coupon bond. So coupon rate is spelled out on the bond. that is interest rate applied to the face value to compute the coupon payment. So if we have this example here, face value is $1,000, coupon rate is 7%, then issuer will pay a periodic payment is $1,000 times 7%, which is $70. And at maturity, the issuer pays the last coupon, $70, and the face value amount, face amount, $1,000. Now, between the issuing date and maturity, there will be some changes in the economy, such as interest can change. Interest will change. And then market value of bond also will change. So we want to estimate an asset's market value, bond market value. Let's see how to figure out value of bond when interest rate changes. Let's look at this example. Face value is $1,000, and then coupon rate is 7%. It matures in 5 years. That is, maturity means the end of life of the bond. But current market interest rate is 6%. This means this bond is promising more interest rate, higher interest rate than current market interest rate. So people want to buy this bond. So people want to buy this bond to get a higher coupon payment. So let's look at let's try to find the value of the bond of this bond with this interest rate. Here, coupon payment, let's say PMT payment is $1,000 times 7%. That gives you $70. That's dollar sign. And then let's look at the time. 1, 2, 3, 4, 5. There will be a payment year 0, 1, 2, 3, 4. That's the end of maturity. But that's the maturity. We purchase $1,000 coupon bond here, right here, and there will be $5 $70 payment. $70 payment at the end of first year, at the end of second year, at the end of third year, fourth year, at the end of fifth year, at maturity, the coupon will be paid. And then what else will be paid at maturity? The face value, $1,000, right? How can you find value of bond at this time? First of all, we need to find out the present values of all of these coupon payment, right? All of these coupon payment first. Total of these present values can be found how? Payment. So we want to find out present value of annuity, right? with 6%. Here, current market interest rate is 6%, so we want to use 6% for discount factors. And then how many years? 5 years. That is payment times present value annuity factor, right? Annuity factor. The payment is $70. Annuity is, well, from your table, you can find out present value annuity factor 5 years at 6%. So that gives me 4.2124. So it is $294.86. Okay. And what else? We need to find out present value of this face value. So $1,000 times present value interest factor, right? From the present value table of a single amount, we can figure out it is 0.7473. So $1,000 times this factor gives you 747.30 cents, like that. You add these up, then it gives you $1,042. This is market price, current market price. Current market price, but this is not actually trading price, but this is theoretically estimated market price. Okay, estimated current market price, or you can say theoretical market price of this bond. So this amount, $1,042 is the amount of the market price you are willing to pay to buy this bond. Okay, this is amount you are willing to pay to buy this bond. Let's look at the same example, but with different market interest rate. With the same example, but with different interest rate, market interest rate is different. In this case, current market interest rate is 9%. Then how can we find the market value of the bond? We are going to use the present value of annuity. Present value of annuity, 9%, not 7%, okay? And 5 years is $70, which is payment, right? Payment, this is payment, multiplied by present value of ordinary annuity factor is 3.8897. This is present value annuity interest factor. Okay, and then we get $272.27, like that. And then present value, we need to find out present value of face amount. Face amount equals, face amount is $1,000, right? That is the value of bond after 5 years, right? So we need to find out a value of $1,000 after 5 years for current market value. So it gives me multiplied by 0.6499. This is $649.90, right? Now we add these two numbers, then it gives me $922. It's about, okay, round. So this is less than $1,000, right? Which is face value. Less than $5, less than face value. Then it is called discount bond. Yeah, it is selling at discount. And this is the amount of money you are willing to pay to buy this bond. This is you are willing to pay to buy. Okay. Let's compare premium and discount bond and try to find some characteristics. Previously, from our example, well, depending on current market interest rate, market value of bond can be $1,042, and it can be also $922 now, right? $922. At this point, it can be well, $1,000. It is called par, face amount. If market interest rate is 7%, it can be a par bond, right? And it was 9%, and then it makes 9% makes it a discount bond, right? And it was 6% to make it premium bond, right? Premium bond. In this case, discount bond. Discount bond, right? As it approaches to maturity, 1, 2, 3, 4, 5 years. At the end of 5 years, it's mature. From here, it increases. Value of bond increases as it approaches to maturity. And then premium bond, value of premium bond goes down, decline until it mature. So at maturity, value of bond should be the same as face value, right? If the bond is promising $1,000 tomorrow, who's going to buy that bond by paying more than $1,000 or less than $1,000? So as it approaches to the maturity, near maturity, the market price of the bond should be the same as the face value. So at maturity, we can say that at maturity, value of bond is the same as the face value. Okay, now we are looking at one example of discount bond. This pure discount bond is the bond that promises a single payment of cash at maturity only. There's no coupon payment between issuing the bond and maturity of the bond. So, and then face value is the same as promised cash payment at maturity, such as a 1-year pure discount bond, or it can be multiple year pure discount bond. Yield rate is face value minus price divided by current price. So let's say this example, $1 million face value. T-bond is selling at $950,000, and then yield rate can be computed. Face value $1 million minus the price, buying price $950,000 divided by the price paid $950,000, right? Then it gives me that is 5.26%. Yeah, most government bonds are pure discount bond. If government bond is $1 million, then mostly it is selling below $1 million to show the interest payment. Most government bonds or municipal bonds or state government bonds